If you've ever had a perfect setup, took the trade, and then watched it go against you, this is the video for you. Most people think that their entries are failing because of their strategy or their timing, but after analyzing thousands of failed trades, I've discovered the real problem. You're reading break of structure completely wrong. I used to have the same exact issue. I'd see what I thought was a clear break, I'd enter a trade, and then I would get stopped out because price would immediately reverse right back into the range. It was frustrating as hell because I knew I could read the charts, but my entries kept failing. Then I learned the difference between a real break of structure and the context behind it and why it works. That changed everything for me with my actual entries and getting stopped out and faked out a lot less. In this video, I'm going to show you exactly why your entries are failing, what break of structure actually means, how to identify real breaks that lead to profitable trades and not immediate stop outs. In 5 simple steps, let's get to it. Now, the first thing that we have to understand when it comes to a break of structure is if you do not have context as to why the market should actually break, that is where we get mixed up. Because the first problem that we have to say is, okay, well, when I do take good entries that I think are good and I take the trade, place my stop, and I end up getting stopped, why am I getting stopped even though I think that it's a good setup? And so that is where we have to understand context and draw on liquidity. Where is the market drawing to? Now, let me show you an example of what you might think is a valid break of structure, and then let me show you more context. Imagine I have a chart here, right? And then we have a move higher, and then we have a break. Most people would look at this and say, okay, right, that's a break of structure to the downside. Let me add more context to this. Now, imagine we then put in generated buy side liquidity above us, and we had already had sell side liquidity taken down here previously, and we already had this move. So now there's more context. This is not just a break of structure. This is most likely a pullback to then continue higher. Now, that one little thing changed completely how I view this. So what we have to understand is a break of structure is not something that is just a pattern. If you use it as a pattern, a lot of the times you're going to find yourself getting stopped out, right? Because you'll take, oh, this is a short, and then it reverses right back on you, and then you go because you don't understand where the draw on liquidity is. Here's another problem as well that I see a lot of people is they look at it at the lowest time frame without the proper validation of a bigger time frame. So for example, let's say the market has been generating buy side liquidity, we come down, right? We're looking to displace back higher. We have one last move and then we break to the upside. So here we go. Sell side's taken and we start to break here. Now this is a valid break in the structure, but a lot of the times what people might end up seeing with this is before there's some sort of manipulation leg, right? So what this means is sell side then gets taken. They take an early long here, and then for the market to just most likely go back lower one last time. What do we need to have for a change in the state? For me to have confidence that the market is going to reverse, for me to have confidence that I'm going to put a trade on, I need to see manipulation, meaning I need to see internal liquidity, right? A lot of the times people are taking trades or reversals based off of something when there is no manipulation. Now, manipulation has to be a move in the opposing direction. So for example, if sell side externally gets taken here and I'm looking to take a reversal possibly to, this internal high or whatever I'm targeting, I need to see manipulation here. So what happens is early longs will get most likely put in. You'll target the long because sell side got taken, and then the market will do one of these numbers, go one last time down, then have a manipulation leg, and then go back higher, right? So what happens is we generate liquidity, this low, to then go take it, then have a break of structure, and then go back to the highs. Now, this is where another problem arises though, because there's 2 different break of structures that are going to happen here, right? If we zoom out, most of the time, there is now another model here. So this is where the fractability of price action gets put in, where this on the bigger time frame is the actual break of structure to what? Validate this as the draw on liquidity. I know I'm going in a lot of different ways here, but I want to kind of throw something at you just to make you kind of start thinking here. What we have to understand with a break of structure is that the break of structure needs context, and that a break of structure is also confirming a bias to us. That is what we're using it as. In this example, 2 models that are playing out here, and I'm going to draw them to you. Now, what do I mean by a model? A model means the efficiency towards whatever the draw on liquidity I'm currently visualizing is. There's this model, which is internally, sell side gets taken, break of structure, I will mark these blue, pull back. So here internally, right, this is break of structure to internal buy side, boom, this model's done. But on the bigger time frame, the buy side here is actually another break of structure to possibly go to the external. Now, when we're looking for an entry, which one of these is possibly higher probability? The external one. Why? Because there's more price action to validate it. Now, what do I mean by that? When we are currently just here, what are we doing on this down move? We're generating buy side liquidity. All of these highs are getting put in. So when this low gets taken initially and all the longs are starting to move first, this is where everybody gets trapped because they're not actually waiting for the bigger time frame change or the bigger time frame break of structure. So what happens is market initially moves back higher to generate liquidity that we will inevitably then come back to. All of the longs are initially initially here. We then go back lower one last time, stop out traders, and then go in its favor. Now, another thing that we want to look for is SMTs, right? I want to maybe wait for it, possibly an SMT to get put in at these lows. So let's say ES fakes, moves back higher, comes back lower, takes the low, then has a break of structure, then also validated by an SMT. And the SMT is basically the divergence NQ and ES or the correlating asset. So what I want to do now is I'm going to pick up area and price action, and I'm going to run you through how I view break of structures so that you're able to see this in an actual market environment. So I'm picking a random area and price action. The first thing that we need to even think about a break of structure is a confident draw on liquidity and some sort of manipulation, because we cannot have a break of structure if we don't know where we're going and we don't know if there's some sort of liquidity that's being taken, right? Because at the end of the day, the only way, again, a break of structure is a pattern. So the context that we need is some sort of liquidity being taken and some sort of manipulation, maybe an SMT and an area that we can maybe have an expected draw. So when I'm looking at just NQ here and we say, where's the market currently right now, right? The first thing I'll do is I'll do a top-down analysis and I'll say, okay, well, we're in the daily. This recent low got taken. So this is just a loose bias. Since this low got taken, I would be pretty bullish. Market gets bought all the way back up, pulls back. Where are we pulling back to? We're pulling back to OTE of this range. So when I zoom in and I'm looking at this day and I'm saying, okay, where can the market possibly draw to, right? Well, where are we? We are in OTE. So what I would be looking for, I'd looking for areas of buy side liquidity. Where's buy side liquidity resting? Buy side liquidity is resting here and buy side liquidity is resting here. Now, what did we also do in this move? We also have taken and ran through this inverse fair value gap. So this is 9 o'clock. I just happened to skip at a really good time here because now we can just actually watch the market open. Market opens. Let's see what we do here. Oh, I'm on the 5 minute. I skipped ahead. My bad. But we'll use this because this is still possible. What I want to notice here is if my draw on liquidity is higher, what do I need to see happen first, right? If I come into a day like this, and I'm saying, where's the market going to draw to? I want to see us draw towards this high because we've ran through the inefficiency. So what are we doing in the morning? We're going lower to what? Manipulate. I want to see us take internal low, stop out all of the initial short traders, and then go higher to go back to internal buy side liquidity. So what would I be looking for? I'm looking for an internal low to get taken, and I'm looking for a change in the state or a break of structure to the upside. So let's zoom in. And again, I want to see this on a bigger time frame, like a 5 minute. I'm watching, I'm waiting, and we're continuing to sell off. So we'll see if we even get this. So now let's zoom in a little bit. We're starting to come back up higher. I would want to see us hold this inefficiency because keep in mind, we also now took all of these lows. So all of this internal sell side, right? What are we doing on the move? I want you to think about the logic of this. Why does it feel like when we take trade, the market, we almost take it personally, like it feels like it's exactly going against us. Like it exactly knows how we're thinking and where our stops are being placed, because that's how the algorithm is built. When we look at a day like this and we're saying, oh, we're bullish, market sells off to stop out all of those traders and then reverse, right? This is a daily profile. The market most of the time will open, move one way, and then reverse the other way if there is a confident draw on liquidity. So what do we have to understand? We have to understand the bigger time frame context here. We're in OTE of the bigger time frame range. We ran through a 15-minute fair value gap. Now internal sell side liquidity has been taken and there's buy side resting above us. I would want to see us reverse to the upside. So I would look for a break of structure. Let's see if we get it here. But more so, I want to show you just how my brain works and what you need to think about when it comes to aligning a draw on liquidity. So far on the 5 minute, there isn't a very confident break of structure and we end up going straight to it, right? So here, there's not really a super clean break. Notice it's kind of a V-shaped recovery. I'm actually glad this was the first kind of replay to show you, is to show you like I'm not picking, random examples or like I'm nitpicking examples. I'm just straight up watching price action. This is a trade where if I had more context, for example, if I was looking at ES, which I can't view ES when I'm replaying, if there was an SMT here, then that would have given me more possible reason to enter without a change in the state or a break of structure. But notice in this case, there really was no break of structure for me to take a trade. So market ends up continuing to get bought up. Again, where would I expect us to? The next draw, buy side internally gets taken. So let's continue to watch price action here. So we go back higher in this range. What would I now expect, right? The exact same thing that I want to do is I want to zoom out and I want to recognize internal price action. Where is all buy side resting? All of this is generated buy side liquidity. So by looking at this chart, I want to see the market go to buy side. Now, what has happened? We have also now had this break of structure to the upside on the bigger time frame. So this is validating this is the draw. So because I know that that is now the draw on liquidity, what do I want to see for me to take along? I need to see internal validation, some sort of internal sell side possibly getting taken or manipulation. Now let's watch the chart and see what we do. Here's internal sell side. There is also a bullish fair value gap here. Let's see what we do. I'd want to see the market go lower first and then higher. If we go higher, there's no setup for me. Market continues to chop. Let me see where open is. So market opens immediately here. And again, what are we doing though here? Market comes down, takes internal sell side. So this is what I would be looking for at open. This is literally perfect example right here. 9:17. The bigger time frame is telling me I should be bullish. Why is the bigger time frame telling me I should be bullish? We zoom out here and we look at the 4 hour. We have all of this buy side liquidity resting above us. We are above an inefficiency. We've already started to displace in the market maker model. I want to see market open, go lower, take some sort of liquidity, and then go back higher. We have buy side liquidity that's been generated. Market opens. And keep in mind, I'm only trading this on New York session. So we have sell side here. This is so important. Watch. What happens here? Sell side gets taken initially, moves back higher, no break of structure, no change in the state, right? There's no break of structure here. This is just a down move and an up move. So there's nothing here. That's why the market, this is where early longs are being taken for then the market to do what? We open, sell off, take the internal low, stop out all the short traders. Now we have something clear to look at. There is a high here. This is where I want to see a break of structure because we've done everything I want. Sell side, the bigger time frame is bullish. There's buy side resting above. Again, what have we been doing all morning? What's the logic behind why this should work? First, let's ask this. What is the logic behind why this break of structure should work? Sell side's taken. Bigger time frame is bullish, right? So we want to be bigger time frame. We have to be a bias on the bigger time frame and align the lower time frame. So the lower time frame is now having manipulation at open. Sell side gets taken. Internal sell side gets taken. This is where I would also be looking for divergences between the assets. So maybe there's an SMT at these lows. NQ took it. ES did not. But now there's a clean area where we recognize a break. If we get above this down close candle, right, that is the recent high after sell side gets taken. Boom. This is where I would long. I would put my stop at the low and I would be targeting all of this buy side, right? Because we generated all of this liquidity here. So now we've taken one side and now we're going to go take the other side after the break of structure. And there we go. So we want to be looking for, again, the only reason a break of structure will work is if there is context to it. The way that I analogize it is you have to view the market as like a game of Pictionary. A lot of the times, the reason why we get stopped out on break of structure or early trades without validation of a break of structure, or at least we think, is because we are trying to see what we want to see, not what the market's actual truth is. So sometimes sell side can get taken and we're so focused on a reversal, but the market actually hasn't validated it. And so you jump in early, then to get stopped. And then after you get stopped, you lose confidence, you're down on the day. So then the odds of you re-entering into the actual good setup is very lower. So you actually don't take the setup when it does appear afterwards, right? This is a problem as traders. So we need to identify the first problem and cut it out. And the first problem means we have to recognize what is the market showing me? Where is the market drawing to? Is there actual manipulation? But the only thing that's going to validate a break of structure is the context, right? Doesn't matter if we displace through a high or a low. The only thing that matters is, are we displacing through a high and a low after manipulation, and is there an opposing draw on liquidity? That is what we are looking. Now, another thing I want to talk about with break of structures is displacement. Displacement is one of the most important things. If we come up, right, and we say buy side's getting taken, some sort of internal high got taken, this would be my break of structure. Now, I need to see displacement through this. If this happens, there's no trade because there's a difference between a sweep and displacement. That's what we also have to understand too. This is a liquidity sweep on a smaller time frame. So liquidity sweep on a smaller time frame to then maybe do this, then break, then go up, right? So notice that the bigger time frame change in the state can actually be a sweep of liquidity, internal manipulation, and then this is a break of structure to the upside because we never actually displaced through the low, right? So what we want to see for a valid break of structure is displacement, us moving through it, and a lot of the times fast, right? We don't want to see us just hesitate, sweep it, and then immediately go back up. We want to see us go through the low, through the high, that is showing us and validating a switch in bias or a switch towards whatever the opposing draw on liquidity is. Now, keep in mind, the opposing draw on liquidity could be equilibrium of that price range. It could be a bullish fair value gap. It could be a form of sell side liquidity. That is where you want to experiment with recognizing price action and recognizing, session highs, right? Session highs are a very high probable target for trading. So for example, imagine Asia session high gets taken and now we're going to reverse back to London session low, right? That's what we want to see and validate. And then of course, maybe there's an SMT here, even adding more validation. But basically the way in which you need to think about it is going into New York session, right? The one thing you want to ask yourself is there's a couple of things, but this is the step-by-step. Where is the market drawing to? What's the overall order flow? Are we where's my buy side? Where's my sell side? Has it already been taken pre-market? Where's the break of structure? Has it been happened? Is there no break of structure yet? And then have an understanding, but a loose understanding, and wait for the market and you be reactive to it. Don't try to predict if there's going to be a break of structure or not, or a reversal, because that's where you take trades and get stopped out. Is you say, oh, the market's going to reverse. Like this is what happens. Oh, buy side gets taken. Oh, the market's going to reverse. You take a short, get stopped out. And then one more time, right? Internal high gets taken and you go, oh, the market's going to reverse. You enter another short setup and then you get stopped again. And then you have a break of structure and then you don't even have the confidence to actually enter it, right? Because again, you're too zoomed in. When you zoom out of the bigger time frame, you realize this is just the manipulation leg and then this is the break of, because you're just too zoomed in trying to catch a top. Wait for the market to actually show you the signs of what it is, right? Think of trading as a game of Pictionary. What happens is like we're we're sitting watching the whiteboard being painted and we're like, oh my God, we're gonna go bearish. I know it. And we want to be right? As human beings, we want to be right. And we say, oh, I'm jumping in early. And then we get stopped. Now, if we treat it like a game of Pictionary and we only get one guess, it's waiting for the entire picture to be there, right? I'm drawing on a whiteboard and I'm drawing, you yell out and you're like, oh, it's a moon. And I say, no, it's not the moon. And I keep drawing and I keep drawing and I draw more. And you say, oh, that's freaking whatever. And I say, no, that's not that. And then I say, oh, and then you're like, oh, I understand now. It's a piece of cheese. And I say, oh, it's a piece of cheese because the full picture was drawn. So you're like, oh, it's a moon. Oh, it's a blah, blah, blah. Oh, it's a blah, blah, blah. And then once you actually see the picture and you see the actual break of structure, instead of trying to guess when the reversal is, because you want to be right and you want to have the least amount of risk possible and you want to top tick the market and you want to fucking post all your wins and shit, right? That's where you are doing yourself the disservice, right? So we have to focus on the market actually affirming to us and giving us the actual data and information to say, okay, this is valid. I can take. Now again, the best confirmation signals for a break of structure is an SMT, liquidity being taken beforehand, manipulation, right? You need to see, when I say manipulation, it means the last move higher. So buy stick gets taken and then we have another leg higher, possibly putting in an SMT and then break to the downside and just having a confident draw on liquidity. Where is the market drawing to? Now, when it comes to entries, I prefer on the break of structure. So if we were to draw out a new example here, I like to take entries when there is an already existing break of structure. So for example, let's say we're looking at this on a bigger time frame. All right, let's touch it. All right, I'm going to draw this example out and I want you guys to see how I would view this, right? So number one, bigger time frame. This is where our bigger time frame bias. We can use like the bigger time frame break of structure to gain a bias as well, right? So we've had a break of structure, right? Where we've gotten above this high and now we're pulling back. Now that we're pulling back in an area in which, again, I expect to be bullish, right? We're coming into an area in which I expect order flow to hold bullish. If we're bullish and we've had a break of structure, that means this fair value gap, I'm expecting to hold bullish. So now what do I want to see? I want to see liquidity getting taken inside of the area I want to see get rejected, because that's validating to me that the market doesn't need to go lower after this. Because if the market is just a distribution between buy side and sell side liquidity, then if we're bullish on the bigger time frame and internal sell side gets taken, there's no reason for price to go lower. So now what I would do is I zoom in. So imagine this is like a 15-minute or a 5-minute. What I would wait for is a break of structure here. So let's say we initially take it, right? Early longs get in here. So now that we've had an internal break of structure, this low gets taken internally, right here, and then we break. That is my sign to enter. So I want to align the bigger time frame, look for the lower time frame. This is where I take my entry, right? On the break or the pullback, put my stop at the low, and I target whatever the internal liquidity is. And I want to base this off of a couple of things, right? If this is, sometimes this market will look like, this is like a very specific example, where to take profits here. Sometimes these highs will be like internally stacked. So if there's like internal stacked highs, a lot of the times this will be my first price target. Like a bunch of stacked internal highs, I'll probably like take partials, move my stop to break even after those partials are taken, and then I let a runner go to whatever the external high is. And that's where trade management comes in, which again, we'll get into another video. But this is what you should be looking for entries. Ask yourself, where's the draw? Look for SMTs, wait for manipulation. If you want the market to go higher, wait for it to go lower first. If you want the market to go lower, wait to go higher first. Trade the break of structure if there's confirmation for it. And that's pretty much it. I just showed you exactly why your entries are failing and how to fix it. This isn't some complex strategy. It's about understanding what break of structure actually means with context. Here's what I want you to do right now. Go to your charts, start looking at recent price action, identify what you think is a break of structure, and now apply what I just taught you and start looking for it going into the next couple days. Most traders never figure this out and they stay stuck. So finally have an advantage. Use it, listen, try it out, build conviction with it. If this video helped you understand why you might be getting stopped on your entries, leave a like, subscribe. If you want more videos on how to read price action and overall trading, leave your comments. Remember, it's not about finding more setups. It's about finding better setups. Master break of structure and your trading will never be the same again. Now, trading alone can be extremely frustrating because nobody understands what it's like to actually be a trader. And that's why we created Tactical Traders, which is my mentorship program where we teach you how to actually trade the proper way and being around like-minded, disciplined individuals who are pushing towards success. I live trade pretty much every single day in the mentorship group, and we have a professional psychologist, her name is Sarah, that coaches with our students as well. So if you're interested in joining our community, I'll put some testimonials on the screen so you can see some of the success from our recent students. If you've been struggling and you're looking for that extra guidance, don't be afraid. I'll leave the link in the description so you guys can check us out, and I will talk to you guys in the next video. Peace out.